Hi everyone, we are Group 14. Today our topic is Coordinated Hedge Fund. We'll talk about the equity performance and also the market analysis. So firstly, let me introduce our data source and some key calculation process from question one. We use data from Yahoo Finance, and the time is from 2016 April 1st to 2026 April 1st. There are 10 years data in total, so the first 9-year data will be used to estimate the beta. Their monthly closing price is mostly because we can get more observations and making beta more precise. And also the price are adjusted price because we are considering stock splits and also the dividend payment. So there's 10 equities in total and also one market index, which is AXJO. We choose AXJO because it's more widely used. And also all 10 equities are included in the index. So we should consider individual stock performance and also the market performance. So we can just use 1 year holding period of each individual stock as the annualized return and then compare it to the market price.
In our result, only 4 out of 10 stocks such as PRN, BHP, RIO, and WHC significantly outperformed the market with returns over 50%, and these are primarily resource and energy companies, while property and consumer-related stocks underperform. In this chart shows the performance of each stock related to the ASX 200 benchmark, which is approximately 10.18%. You can see stocks in green above the benchmark line outperform the market, while those in red underperform. For example, Whitehaven Coal delivers the strongest return, likely driven by elevated coal prices and strong global energy demand. In contrast, Stockland underperformed significantly, reflecting pressure on the property sector due to rising interest rate. Overall, the portfolio shows uneven performance, reflecting strong sectoral diversity. This variation raises the question of whether returns match risk, which we assess using CAPM.
Hi, this is Jinlan. To evaluate our 10 stocks, we need a fair benchmark, one that adjusts for risk. That's what CAPM gives us, with a risk-free rate of 4.1% and the ASX 200 returning 10.2%. The model tells us what each stock should have earned given how much market risk it carries. The split is exactly half and half. 5 stocks beat their CAPM target. PRN, BHP, RIO, and WSC didn't just beat it. They demolished it, delivering 50 to 60% returns against expectations in the single digits. The other 5 missed. SGP returned negative 19 against an expected positive 14. HVN, NEC, PPT all carried high betas, meaning the market priced in significant risk, but they never delivered the return that risk demands. So half our portfolio generated extraordinary alpha, half destroyed it.
Thank you, Jane. Let's now turn to how the portfolio performed. Applying CAPM at 31st March 2025, the 80/20 Continental Fund had an expected annual return of 9.67%, computed from a portfolio beta of 0.916, the weighted average of the equity sleeve beta and the bond sleeve zero beta per the risk-free assumption. The portfolio's realized return of the following year was 19.46%, achieving a positive Jensen alpha of 9.79 percentage points, significantly surpassed the CAPM expectation, showing superior performance in terms of return. The equity sleeve drove all of the outperformance, while the bond sleeve, treated at held to maturity, delivers 4.11% coupon at zero alpha. We then used the trader ratio to test whether the portfolio met its mandate of beats the market without higher risk. The trader ratio measured the reward per unit of systematic risk, and the portfolio scored 16.76%, nearly 3 times the market performance. On a beta basis, the firm also performed well, and the mandate is met.
Hello, today I would like to share our findings for question 4, focusing on whether there exists an optimal allocation ratio between our stock portfolio and bonds. In modern portfolio theory, an optimal allocation is one that either maximizes expected return for a given level of risk or minimizes risk for a given level of expected return. Now let's apply this to our data. We compared two specific allocations, an 80-20 stock bond mix and a 50-50 mix. Our calculations shows that while the 50-50 portfolio has a lower standard deviation than the 80-20 portfolio, the 80-20 portfolio delivers a significantly higher expected return. But risk-adjusted return is the key metric here. When we calculated the Sharpe ratio for both portfolios, we found that the 80-20 allocation has a higher Sharpe ratio than the 50-50 allocation. This tells us something important. Even though the 80-20 portfolio has higher volatility, the excess return it generates more than compensates for the additional risk. In other words, for every unit of risk we take, we are getting more excess return with the 80-20 mix. Of course, optimal is relative to an investor's risk tolerance. In conclusion, yes, there is an optimal allocation, and in this case, our data suggests that 80-20 is a more optimal choice than 50-50 because it offers superior risk-adjusted returns. That's all. Thank you.